Hi guys. Today we will analyze Walt Disney stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Disney was a bad performer in the overall market in the last year. The short-term trend is positive, while the medium and the long-term trends are still negative. It may take some more time to really turn around the trend. Support level is around $142. Strong support level is around $130. Resistance level is around $162. Strong resistance levels are around $182 and $188. In the last month the stock has been trading between $129 and $157 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 12.5 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 5% per year, for last 5 years. We see that the average profit margin of the stock has been around 10% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 33% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Disney Company: bad, average, and good. First scenario. Disney will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 8%. Future profit margin would be low, 10%. Future free cash flow to net income rate would be low, 50%. In this case, the fair value of the stock today would be $41. Second scenario. Disney will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 10%. Future profit margin would be average, 13%. Future free cash flow to net income rate would be average, 55%. In this case, the fair value of the stock today would be $61. Third scenario. Disney will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 12%. Future profit margin would be high, 15%. Future free cash flow to net income rate would be high, 60%. In this case, the fair value of the stock today would be $82. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 1.72. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Disney, analysts forecast growth rate around 12% per year in next 5 years, and future P/E around 32. Again, I will use 3 different scenarios for Disney Company: bad, average, and good. First scenario. Disney will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 8%. Future P/E would be low, 18. In this case, the fair value of the stock today would be $22. Second scenario. Disney will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 10%. Future PE would be average, 24. In this case, the fair value of the stock today would be $35. Third scenario. Disney will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 12%. Future PE would be high, 32. In this case, the fair value of the stock today would be $55. As you can see, today the stock is overvalued, $154, even if we expect the company's high performance in future. Both the profitability and the financial health of Disney are neutral. Nothing too spectacular is happening here. The stock shows good growth, but it is already valued too expensive. I may consider buying the stock if it drops below $100, it's too expensive at the moment. Company's strengths. The Walt Disney is a leading and diversified media and entertainment conglomerate with key operations in theme parks, television, filmed entertainment, direct-to-consumer, and other businesses. The company owns and leverages well-known brands, ranging from Mickey Mouse and Frozen to ESPN and ABC. The Disney Plus launch was a success even before the pandemic, and pandemic lockdowns further increased the use of the service. The direct-to-consumer business now has 179 million subscribers, far outpacing its Hollywood rivals. In Q1 '22, Disney has again demonstrated the power of combining high-quality popular branded content with strong distribution execution. Disney is the first Hollywood studio to seize the initiative in a rapidly changing consumer entertainment environment that is moving towards streaming digital video with anytime anywhere accessibility. Disney's profit margin of 4% is amongst the best of the industry. Based on estimates for the next 5 years, Disney will show a strong growth in earnings per share and in revenue. The EPS will grow by 30% on average per year. The revenue will grow by 12% yearly. Risks. Forecasting Disney's future is even more difficult than usual given the uncertainties surrounding the severity and duration of the pandemic, and its outsized negative impact on two of the company's key businesses, theme parks and theatrical content. Disney may also face margin pressure in FY22 as it increases spending on Disney Plus content, the overseas expansion of streaming services, and new parks rides. Disney has a return on assets of 1.5%, it's comparable to the industry average. However, Disney has a return on equity of 3%, this is below the industry average. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.